Thanks for tuning in to Talking Point. I'm your host, Neeraj Shah. The rally in the Indian equity markets, as also maybe the world equity markets, continues unabated. The characteristic feature of the last couple of months of this rally, or maybe the last 45 days, has been the breadth of the market. And more importantly, it's not just the quality small caps which are moving up, but almost everything that people can think of is moving up. You have a news story, the stock moves up 10%. You have some positive whiff in the sector, and almost all the stocks in that space start moving up. Now, is that a bit unnerving, or is that par for the course? Let's put that question across to Pramod Gubbi. They've come out with a very interesting newsletter, which actually kind of speaks about the nature of the rally in the small caps, and I would want him to dwell upon that and then try and tell our viewers, all of you, as to what are the kind of small caps that you could probably hold on to without having too much of fear as well. Pramod, so good having you. Thanks for joining in. Hope all is safe and wish you a happy 2021.
Thanks, Dheeraj, and wish you and all the viewers a happy new year as well. Pleasure to be here.
Thank you so much. So, Pramod, let's talk about this. It was uncanny, right? That I was talking to you about whether small caps can be a point of conversation, and you guys came out with this newsletter, I believe, day before yesterday, if I'm not wrong. Can you tell us what prompted you to write about that?
Yeah, it is. It's one of the things. Rally is good in the market. It creates wealth for everybody, but we also need sustainability. And more often than not, what we've found is as people enter these sort of periods in the bull market where everything and anything is rallying, we worry. But we worry for those investors because historically, such rallies have eventually ended with a lot of tears for those investors who got in, simply because they couldn't discern between good businesses and the not so good businesses. And our worry is, given the number of new demat accounts that are getting opened, a lot of new investors coming in, and this sort of rally without any distinction between quality of the businesses will end up disappointing these investors who starting to dip their toes in the market, and that will cause another sort of a stigma in people's mind about the risk of investing in stock markets, that they may never show up in the market again. And we thought it's about time to bring this concept up. India particularly is a very bottom-up stock pickers market, whether it's in large cap and small cap. Small cap, it's even more exacerbated, and which is what we thought we'll bring out in a newsletter, which will lay it out threadbare as to why quality and quality alone will make money in the long run.
Yeah, Pramod, how does an average investor try and navigate through? Because for a lot of people who are probably our viewers as well as viewing all market conversations, they are seeing their peers, their neighbors, their friends touch almost anything and turning to gold. So as important as it is to look at the long term, when you look at short-term portfolios and how you see the neighbor's portfolio rising, but yours doesn't because you're stuck to quality, it kind of mentally backfires upon you. So how do you bring about this discipline of not letting these price moves impact you? Let's talk about the mental aspect first, and then we'll talk about how do you guys go about choosing between the right and the wrong in the small cap side.
Yeah, look, this is pretty much the crux of everything that we do in investing, the behavioral aspect of it. The rest is all pretty much sort of school level knowledge that you need. There's no rocket science involved in investing. It's mostly commonsensical. But the behavioral aspect is something I don't think anybody has figured out quite easily. In my view, I think it's still something that you have to go through yourself, make those mistakes. Hopefully those mistakes are not big enough that they damage you permanently, something that you can recover. And we've seen this in the past, right? 2020 is not the first time. I think very recently, 2017, we saw exactly this sort of thing play out. And I know several investors who got weird into that path of buying anything and everything, particularly the low quality, which doubled and tripled during that period, only to lose 80-90% of that in 2018. And through 2019, the small cap correction continued. Now, imagine even after this rally in 2020, the small cap index is barely back to its level. right? So that's the sort of drawdowns you see in small caps, and I can't see any other way where people can learn these behavioral lessons rather than make those. Other than make those mistakes themselves. And like I said, fingers crossed those mistakes are not fatal.
Yeah, fingers crossed those mistakes are not fatal. I think that's the point, viewers. Keep in mind that you may make small gains on your portfolios in the small cap space, or your neighbors may. But when the drawdowns happen, if your portfolio is overburdened or overstretched with these small caps, then it could pull you down down so much so quickly, and you may not have the ability to rise again very, very quickly as well, because capital is finite. So, Pramod, tell us, there are these very interesting observations that you guys have put in about how in the past rallies, there are companies which had a particular set of ROC and debt levels which came off, and you're seeing some patterns of that in the current up move as well, wherein companies which have a net debt to ROC ratio or some of the others that you've used are coming off. Can you explain, therefore, how
Sure.
can people very simply uh, kind of avoid the pitfalls in the current move?
Correct. So I think one thing to know is that this whole fascination about small cap doesn't have any sort of basis in terms of data underlying it. Small caps, by and large, have performed in line, depending on what starting periods and ending period you take for the data analysis. The long-term small caps, perhaps return-wise, perform in line, or perhaps slightly shade lower than, say, your Nifty or Sensex, but they give the same sort of returns with a significantly higher volatility. So from a risk-adjusted return perspective, there is no case to be built for small caps. However, we know a lot of investors who make a lot of money in small caps. How does this happen? So, an analysis we did about a couple of years ago when we launched our Little Champs fund was we sliced and diced the data between large, mid, and small caps based on stock price performance and earnings growth. And we divided each of these baskets into quartiles of stock price performance and stock earnings growth. And what we found was very clear. The quartile one of small caps, which is in terms of stock price performance, significantly outperformed the best performing mid caps and the best performing large caps. And the same thing in terms of earnings growth. The small cap companies with the highest amount of earnings growth demonstrated significantly higher earnings growth in the best growing or the fastest growing mid and large caps. So there is a distinction there. There is a distinction for large caps or small caps doing better than large caps. But if you move to the bottom quartiles for each of these market cap segments, you found exactly the opposite. The worst small caps significantly underperform the worst large and mid caps, both in terms of share price performance as well as earnings growth performance, right? And that clearly brought home this point about stock picking that I talked about. It's simply not enough. India particularly is a bottom-up market. If you are able to discern the better ones to the not so good ones, your outcome will be significantly better than where you do spray around and see if you make money. And the parameters that work very well in terms of picking, certainly ROC, there is significant data which shows that better ROC companies deliver significantly better outcomes in terms of stock price performance, as well as earnings growth. Earnings growth in some ways is a reflection of your ROC. If you're a high ROC generating company, obviously you're left with a lot more capital to invest and fund future growth. So if you stick to parameters around ROC and earnings growth, you will find that over the long run, you're bound to perform better. One of the other analysis we did, now why then? Because the data shows that between April 2020 and December 2020, this hasn't worked. The poor quality companies with low ROCs and low earnings growth have outperformed the better ones quite significantly. Now, part of the explanation is, of course, arithmetic in nature, because these companies fell so much during January, February, March. The little bit of bounce arithmetically will mean that if you take the starting point as the bottom of the market, you will find them doing better. But our sense is there is more to it, and people are getting carried away in identifying these companies. Some of the things could be that they are trading at ridiculously low valuations. Perhaps a lot of that low valuation is justified given the low quality of those companies. But the January, February, March experience itself should warn people against building such portfolios, because the sort of wealth destruction that happened during Jan, Feb, March, if it were to happen, let's say there is another bout of COVID, or geopolitical issues, or oil prices rising, which is a real thing. I think I'll come to the risk of inflationary pressures due to the commodity rally, particularly on small caps, and particularly on the weaker small caps. But any such trigger can cause a drawdown, which means that you will see the same sort of situation for the weaker quality small cap companies that happened in Jan, Feb, March. So the only way to make money in the weaker quality small caps is if you can time your entry and exit to perfection. And that is something that we've found in history extremely difficult, or at least we at Marcellus don't even attempt doing that. And to be honest, we don't know enough people who can do that perfectly as well. So given that inability of ours to actually get in only at these times and get out just when the froth is building up, we'd rather look at the long term. And over the long run, we've shown, and this particular newsletter also shows that ROCE, low net debt to equity, and strong earnings growth are the biggest drivers of long-term returns as opposed to anything else.
Pramod, just a couple of questions. The second question would be what you said, that you would want to explain the impact of this commodity price inflation on small caps. But before that, the first one, and that question is that so I agree that a lot of the market in the small cap space, a lot of froth has gone up. My question is, if at the current point of time, let's assume you're getting capital into your small cap portfolios, are you comfortable deploying that capital in a company which has got all the quality characteristics which you very strongly stick to, but is argument's sake on a PE basis fairly highly valued, even if PE may not be the right multiple? I'm just using that as an example. Versus a company which may not be at the picks when it comes to these ROCs, which is somewhere in between, but the valuations are a lot more favorable, and maybe in the same sector that you guys believe there is earnings growth potential, and therefore it may not grow as much as the leader, but will still grow well. May not have the ROCs as much as the leader, but still has decent ROCs, and on valuation front is much lower. Would you be comfortable buying this player, or are you still wanting to deploy in the expensive ones?
Yeah, I mean, the expensive and relative is, expensive or cheap is relative to its own fundamentals and not relative to its peers, because the fundamentals can more than justify the higher multiples. Point number one. Point number two, we've shown that entry level PE multiples or valuations barely have any contribution to the eventual outcome, particularly if you're investing for the long run. And the long run I define as 3 years and beyond. Over the long run, almost all your returns can be explained by earnings growth and earnings growth only. There's hardly any impact coming from, say, you buy a stock at a low PE and the PE multiple increases. That's a very smaller contribution, and that's something that we can't predict, right? So therefore, when we buy a stock, we buy with the view that there is no appreciation in PE multiples. In fact, we do build in some cushion for PE multiple deteriorating. And therefore, the only engine of our returns is going to be underlying earnings growth. So that means, to answer your question, we would still prefer the companies with the best sort of fundamentals, with the best comparative advantages, even if it means that it were trading at a higher multiple relative to its peers. Because mind you, for us, that multiple is not relative to its peers. The multiple is relative to its justified multiple based on its underlying cash flows. And even today, when we are deploying capital, we still ask the same question: is the company's fair value PE significantly higher than the current stock price? Okay. Remember, the fair value PE is derived out of long-term cash flows, which is what contributes to the value of the company. And unless and until there's any change in those fundamentals which affect long-term cash flows, we believe that an absolute PE multiple really doesn't have any meaning by itself. A 10 times PE multiple company can be expensive, and a 50 times PE multiple can be cheap. But yeah, we would still go for quality.
Got it. Okay. Well, that explains it beautifully. Before we get to some individual themes, Pramod, last question on the point that you made, that the impact that select drawdowns can have. Can you elaborate a bit on that?
Yeah, I mean, so the cause of the drawdowns could be anything, but the ability of the company to sustain these adversities makes a big difference. And we've shown in this data as well that almost all your alpha comes during the bear market. If you've invested in a stock which has fallen only 10% as opposed to 35% for the index, remember, for you to come back to your original levels, it takes 11% appreciation. Whereas the index, which has fallen 35%, needs to literally go up 50% to regain its original thing. It's a very simple arithmetic measure, but it works beautifully. And this is what I guess the likes of Warren Buffett were talking about when they talk about two rules of investing. The first rule is don't lose money. Second rule is don't forget rule number one. If you don't lose money, then making money over the longer run becomes that much more easier. And this is what investors need to remember, how much hard things can make for you if a downward to occur. So if you can fall less during the fall, you can somehow back yourself to come back and regain your original ground.
But you are saying that commodity price upticks can have a significant long-term lasting drawdowns on companies which don't have sound fundamentals in the small cap space. And those sound fundamentals are a higher ROC, because that kind of imbibes a lot of good qualities, underlying qualities of a company.
True. I mean, in some ways, it boils down to pricing power, right? The high ROC is effectively a reflection of high pricing power. You're able to generate a high return on capital over cost of capital because you have something unique that your competitors find it very difficult to replicate, and that's a reflection of your pricing power. Otherwise, competitive forces in a free market would push down return on capital closer to cost of capital. The fact that this company makes significantly higher ROC suggests that these forces don't work, because this company has very unique competitive advantages, and that reflects in pricing power. If you have the pricing power in times like this, when commodity prices, which are raw material for the company under question, rise significantly, you can demonstrate or implement that pricing power by passing on the prices to customers, or negotiating better prices with vendors, or because you have a superior supply chain, you can absorb the increase in pricing power at the expense of maybe extended working capital days. Generally, that cushion between return on capital and cost of capital can allow you to survive these times, as opposed to a company with absolutely no pricing power or competitive advantage. And that is what causes a drawdown on the fundamentals itself, and therefore the share price soon enough follows that. So it is important to assess this pricing power, and a historical analysis of ROC just gives you a sense that there is an element of pricing power. And for those who are willing to get down on the ground to understand why does this company make high ROC, you'll even be able to understand where does it draw its pricing power from.
And maybe that's a good advice, viewers, that if you want to invest in a company, try and do these not small things really, but these basic things which are a necessity before you go out and invest your hard-earned money. Unless you want to punt, of course, in which case you don't even have to hear this conversation. Okay, Pramod, let's try and talk about some of the themes wherein you believe that, and again, these may not be indicative of the whole sector doing well, but I'm assuming that for a company to do well, the underlying theme also would be doing well, because there are only few instances of a company really doing well when the sector itself isn't. Where is it that you believe within the small cap universe that earnings growth have the potential to last for FY21, rather 2021, 2022, 2023 and beyond, from where we are right now? Which themes?
So look, I mean, like I said, India is a bottom-up market. We'll have to find companies which can stand on their own, irrespective of which way the macro wind is blowing. It's very difficult to assess macro and predict macro, as the last 5 years have shown, right? So almost pretty much every year of the last 5 years, we've been hit by some sort of headwind or the other, whether it's the banking system review under Governor Rajan, or demonetization, or the introduction of GST, which disrupted a largely informal economy like India, and finally the NBFC crisis with ILNFS and DHFL, and COVID itself. So let's not back ourselves to say that the macro will help us drive. Having said that, if I look into my our Little Champs portfolio, there are some themes emerging. Particularly one of auto ancillaries. Auto ancillaries, perhaps one sector where we have the highest exposure to. And auto ancillaries demonstrate generally very classic characteristics of hidden champs. Remember, Little Champs is inspired by this book called Hidden Champs by Herman Scheinman, which talks about how auto ancillary or capital goods companies which cater to larger OEMs and piggyback on the success of these OEMs simply because they became very, very critical to these OEMs. If you can identify companies which are maybe very small component suppliers, but the OEM simply cannot live without this vendor, and this vendor does it in a way that you have an even keel relationship between a larger OEM and a smaller auto component member. And given where we are in the automotive cycle, I think we had a little bit of a correction across all three categories in terms of four-wheelers, two-wheelers, and commercial vehicles over the last 2-3 years in terms of volume growth. I think we are at the beginning of an auto cycle picking up. And if you can identify the high quality auto ancillaries which cater to these OEMs, irrespective of which component they are in, I think that's one theme worth watching out for in terms of superior earnings growth over the next 3 to 5 years. Another one is, of course, financials.
Pramod, yes. sorry, just before. So you are playing this via Suprajit, right? You guys, I mean, because you lay out your portfolios any which ways and you spotlight it to all subscribers. I'm just asking you are playing this via Suprajit, right? Or are you playing it to some other way as well in the small cap space?
No, we do have other auto ancillaries in the small cap portfolio. There is Suprajit, we have PPAP, we have a couple of other Lumax and so on. So there are 4 or 5 auto companies. We found companies where, again, like I said, the critical thing is the OEM has to depend on you, right? Because there is a significant difference in the scale. We don't want unnecessary bargaining power with the OEM where you're left being squeezed by the OEM. So there has to be a certain criticality that you're offering, either because you have very superior product technology or you've demonstrated significant efficiencies in terms of delivering the product at the lowest cost possible, because you've got those efficiencies on the manufacturing level, or in terms of supply chain, you're willing to locate your plants closer to your OEM's factories and crunch their working capital cycle as well. So whatever be the source of the value add, if you can demonstrate that, and typically it takes a long period of time to prove yourself to the OEM, and that naturally becomes an entry barrier, because if tomorrow somebody were to attempt doing that, they would also go through the same rigor and diligence on behalf of the OEM before they become a tier 1 or tier 2 vendor for that. So these natural entry barriers, sticky relationships with OEMs because of one of these sources means that it becomes an attractive sector. The downside is, of course, it's a cyclical sector. You live and die by the fortunes of your customer, which is where I said that if the last 3 years were to go by, the auto correction means that the worst is behind us for autos. There is a reasonably high chance that over the next 3 to 5 years, we'll see an upcycle in automotives. So that gives you a nice tailwind as an auto ancillary, if you've done all the other things right in terms of becoming very, very important and critical for your customer.
Got it. Okay. You are beginning to talk about financials being the other theme, and seemingly that you don't believe that it's only the top 3 financial names which will do well. There is high quality at the bottom end too, in terms of the market cap.
Yeah, I mean, there is a bit of a caveat here. Generally, we don't find too many financials in the true small cap space. You'll have to slightly move up the market cap spectrum. And there again, there is an element of cyclicality. Given you ask for a thematic, when we buy stocks, we buy with the view that we would never want to sell, irrespective of what stage of the cycle. But for those who want to see some themes for a 3-year period, I think financials is the space to be, because this is one sector which is likely to consolidate significantly. Again, coming from that theme of low quality, high quality, I think this is one sector where we have seen significant differential in performance. And as we come out of this whole NPA recognition moratorium period that the RBI has delivered, we will see the wheat separating from the chaff. And this is a great time to look at a sector which is very closely linked to the economy, and therefore it should benefit disproportionately higher if the economy were to recover, which is our base case scenario. And within that, if you're able to identify the ones which have managed to keep their asset quality intact and therefore their balance sheet intact, they'll be in a position to participate in this economic recovery through better loan growth and better earnings growth eventually, as opposed to those who are struggling with asset quality, struggling with cost of funds because they can't access liquidity in the wholesale market. They don't have the retail liability franchise and so on. So I think that's the other theme worth watching out for.
Okay. There are some individual names which are probably not part of a sector, so to say, right? And you guys have, of course, liked them. So the GMM Fodlers or the Garware Technical Fibers, which is announced a buyback, etc. So all of those are also doing rather well for themselves. The one question that I have is on the two spaces which have a bunch of mid caps and small caps. And I wonder if you have any presence there or if you believe those sectors have tailwinds, which is mid cap pharma and specialty chemical.
Yeah, specialty chemicals is, of course, the third theme. If you were to sort of look for themes within our Little Champs portfolio, you'll find a fairly disproportionate presence of specialty chemicals. In some ways, we do consider GMM Fodler as playing into that space itself. In fact, it's right in the middle of pharma and chemicals. Because it provides equipment. Much like you can play the auto cycle through exposure to auto ancillaries, you can play the chemical and pharma cycle through suppliers to these chemical and pharma companies as well. So GMM Fodler provides glass-lined equipment to both the pharma and chemical industry, and that provides a nice tailwind in terms of demand. But within that, GMM is the market leader by a big margin. And that sort of theme we've found in some of the other specialty chemical companies in our portfolio, whether it's alkyl amines, which is a market leader in aliphatic amines, which is a duopolized industry to start with, extremely high entry barriers through strengths in chemistry and technology, government approvals, access to raw material, and also again very similar to the auto ancillary. Their customers, which are large pharma or chemical companies, have worked with them for so long that if anybody were to displace them, they'll have to invest several years in terms of getting the customers nod for their capabilities, and more importantly, reliability in servicing the customer. So yeah, I mean, specialty chemicals is something that is also sort of an overarching theme in our portfolio.
Last question, Pramod. How do you resist the urge or the temptation or the desire to book profits in companies which have risen disproportionately? I mean, GMM Fodler, for example, when you guys bought it way earlier, it went all the way to 6,500, etc. Or an alkylamines, which I think is, I mean, just shot up, right? It was maybe 2 years ago, it was at some 600, $700 or what have you, and currently at about 5,000 odd. If my memory is, I mean, the last I checked last week was somewhere around that level. What do you tell yourselves when you kind of look at such meteoric price rises, and no doubt an uptick in valuations, because such a price rise cannot just be purely earnings. It is also an uptick in valuations that has happened.
Yeah, I mean, two things. One is we keep reminding ourselves, okay, let's say if we book profits, what goes to show that it won't go higher from here or go through a time correction, or will we be able to make up the mind to buy at lower valuations? The one thing that we have kept reiterating to ourselves is that we have no ability to time stock prices. In fact, we have no idea where stock prices will be tomorrow, day after, next week, next quarter, and so on. But we do think as a team we have a significantly better hold on where profits of the underlying company will be 3 years and 5 years from now. Right? So in some ways, ironically, the long term is far more easier to predict than the shorter term, and particularly fundamentals are far more easier to predict than stock prices. That's point number one. Point number two is give ourselves that long-term luxury. If we were like quite a few of the market participants looking to make a quick buck over the next 3 to 6 months, I think we would be worried about the move in alkylamine stock price, or what GMM went through earlier last year, because we give ourselves this luxury thanks to our client base, which gives us the luxury of investing for the long term. We don't really panic in these situations, because we believe that the improvement in long-term fundamentals of the company still makes the current price quite attractive. And this was the case for GMM Pfaudler even at 5,000. Remember, this came on the back of GMM's acquisition of its parent, which suddenly gave it something like 40% access to a global market, significantly larger than its current presence. Very few people sort of appreciated that move. So we reckon that the long-term value of GMM is significantly higher than 5,000. And similarly with alkylamines, I think notwithstanding the price move over the last week or so, the long-term value for alkylamines is getting even bigger and bigger. So like I said earlier in the conversation, we still consider, not just while making an investment, even while holding an investment, we ask ourselves, is our relatively conservative assessment of intrinsic value of the company still significantly higher than the stock price or not? We do look for that margin of safety. And like I said, because we look for long term, as long as the answer to that question is yes, we don't get perturbed by the stock price movements. And one small aspect is we're perhaps one asset management organization where we don't have a TV in our office. We don't look at stock prices. Most of us don't know the stock prices of our portfolio companies through the day. Maybe we'll check at the end of the day, and that sort of keeps you away from this noise and lets us focus on the signal, which is fundamentals.
Well, if that helps in doing the good work, then keep that up. But yeah, keep up the good performance, Pramod. 2020 has been a spectacular year for you. Hopefully the years ahead are even better. Thank you so much for speaking to us today on Talking Point.
Thank you very much.
And viewers, I hope you enjoyed this conversation as much as I did. It's food for thought if you are indeed invested in small caps as to how to go about and how to discern between what has gone up and what can still go up. Hope this helps.